morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, and let's talk a little bit about This Is Nuts, because that was the article we wrote this past weekend. It's our newsletter. It's on the website now. Simply go to realinvestmentadvice.com, click on the newsletter link, and the article called This Is Nuts Again is something that we wrote back in January of this year when we originally wrote the article, This Is Nuts. The point is that whenever you sit down into an investment meeting and the first thing that people say is this is nuts, is that it's probably time to take a look at your portfolio and think about risk management, risk controls, taking some profits. That's what we were doing last week, particularly with stocks in the NASDAQ. Apple, Microsoft, Amazon. These companies have had fantastic runs over the course of the last year. In fact, they're up 20% or more this year in a market that's still really relatively flat since the beginning of this year because of the virus. Earnings are weaker, outlooks are weaker, economic growth is weaker, but yet these stocks are registering all-time highs in their positions. We're talking about companies like Apple that really haven't grown revenue since 2018, but trading at an all-time high. These deviations really don't make a lot of sense currently, which is why we were talking about taking profits and reducing our risk. Now, clarification. Taking profits does not mean we sold the entire position. We sold small portions of our positions. We still own them now because why? Well, markets are still going up at this point, so we do want to participate. But understanding risk and control is very important. And particularly back in January when we originally wrote this article, we were talking about the NASDAQ being 2 standard deviations above the 200-day moving average. And that was a fairly extreme deviation in the market at the time, suggesting that we needed to reduce risk at that point. Today, the NASDAQ is now trading 3 standard deviations above the 200-day moving average. Now, that's technical mumbo jumbo, but what that means is that we have now stretched this deviation to a point to where normally you have corrections in the markets. In other words, something will cause a pullback in prices, whether it's earnings, some exogenous economic event, whatever it is. Ultimately, what will happen is that you will get a contraction in prices that'll leave you a better buying opportunity to add back into positions at some point in the future. So this was the point that we said back in January when we originally took profits. Of course, that gave us a better buying opportunity to buy those shares back in April and May. Now, after a big extension here, we're once again in a position that we need to take profits. But this is just part of risk management. Again, it doesn't mean that we sold the entire position, doesn't mean that we're in cash and short the markets, doesn't mean anything at all like that. What it does mean is that we are reducing our risk in our portfolio temporarily until we get a better buying opportunity to put that cash back to work. This is just part of risk management, risk control, but we went through this entire analysis in this weekend's newsletter on the website now, realinvestmentadvice.com. Just click the newsletter link. It's called This Is Nuts Again, Why We're Taking Profits and Reducing Risk. And again, this is just part of a long-term portfolio management strategy to create returns over time and protect capital. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you next time.